Welcome back everyone to the Money Control live stream. You're watching another edition of Markets with Santo and CJ. And well, short covering it is. As we spoke about in the morning, Santo, I had alluded to the fact that because of the expiry of July derivative series tomorrow, generally you tend to see some squaring off of positions ahead of it a day before. And today we have seen some bit of short covering happening in the market, especially in the second half. Reacting, of course, to some of the positive cues that are also emerging from the global markets. European markets were largely positive. Plus, the US stock futures were also quite positive. The Dow futures are at one point of time higher by about 200 points, and that is clearly reflecting in the Nifty and Sensex, which are near the highs of the day and heading for a positive close at this point of time. Also, but worryingly, I mean, to offset all of that, we have the volatility index Santo, which has now risen for the third consecutive day and was higher by about 2%. So clearly, an almost 11 to 12% move on the volatility gauge, which basically is expected given that we have a big event coming later in the evening. So clearly, you will see a lot of traders trying to hedge their positions in the option market, and I think that is why we are seeing the jump in VIX.
Well, at this point, I think market almost seems to have taken for granted that the Fed will be sticking to its script of a 75 bips rate hike, and that probably could be triggering some of the short covering. That said, CJ, it's still anybody's market, at least for the next couple of quarters. There are plenty of concerns. You're not. My whole argument is that you're not seeing any major triggers which could take the market really higher. Be they technical or fundamental at this point.
Absolutely.
So I think we need to be ready for this kind of a market where you see indices moving within a narrow band for some time, and neither giving a opportunity for the bulls or the bears.
Yeah, I mean, clearly, I mean, as a bear heading into the earnings season, you would have expected that we will see stinkers of numbers coming out from company after company, and that could trigger or maybe lead to the downfall of the last remaining pillar of this bull market. But clearly, earnings have also not been that bad. They have not been great, but they have also not been that bad, and therefore leaving the market nowhere, literally in no man's land. So clearly, I think it will be interesting to see how we react tomorrow morning and how the Fed meeting later in the evening develops. But that said, there were a lot of stocks that were in action, a lot of individual action happening in the market, starting off at Santo.
Coromandel International has been one of the stocks, a steady performer for
good results today,
and good results as well. And despite rising expenses, the company still has been able to kind of hold on to its margin. There's been some bit of pressure nevertheless, but on the whole, the measures that the company has taken over the past many months, that is slowly beginning to bear fruit. So the company has strengthened its focused on backward integration and gone for strategic procurement, which has led to an improvement in its EBITDA per ton. There's been almost a 12% EBITDA per metric ton. That is,
right.
There's been an increase of almost 12% in FY22, and that is likely to continue this year also. Besides that, it's expanding its product portfolio to include more of the complex agri inputs. So that's another measure that the company has taken. Besides that, it's venturing into drone spraying mechanisms to address the need for highly efficient delivery systems. So at this point, CJ, a lot of things seem to be falling in place for Coromandel International. Motilal Oswal is bullish on the stock. It has a price target of 1160 rupees for Coromandel International and sees a 13% growth in revenues and 10% growth in profit after tax between now and FY24.
Well, that's not really too inspiring for me. Santo, I love chasing high growth, so 10-13% probably will not do it for me. But that said, if you look at the numbers of Coromandel, clearly a lot to be happy about. The only thing that probably would stick out as a sore thumb would be the margins. I mean, clearly on a year-on-year basis, we have seen some sort of shrinkage in the margins or operating margins of the company, and I think that is expected given the fact that even in this sector, costs have risen, raw material prices have gone up, and I think this is something that could continue into the second quarter as well, Santo. Even though prices have moderated, raw material prices have moderated on a sequential basis, but I would expect that on a year-on-year basis, you could still continue to see margin pressure for the company. So that will be my one point. And lastly, the stock already, I think, given it's been one of the best performers out there in the market this year, and I think a lot of the earnings optimism is already being reflected in the stock. So going ahead, I would not be surprised if we start seeing some bit of profit booking in the second half of the year. But of course, clearly it's better to have those gains in your hand than not have them. And in that sense, Coromandel clearly has been one stock that has worked out for investors at large in the market. One stock, on my radar, Santo, and a lot of people probably would be scratching their head as to what is happening with this counter, that is Zomato. Well, after almost a 20% down move in the past 2 days, today the stock was higher by almost 4%. Whether it's a dead cat bounce or whether it's the company turning a corner, it remains to be seen. But clearly, a lot of high volumes on the counter today, and I think a lot of it is coming from the fact that maybe there is this realization in the market that valuations finally are reflecting the realities, and therefore there is a lot of comfort for longer term investors. If you look at some of the brokerage commentary that has come in over the past 2 days, I mean, you have Credit Suisse coming out with a very positive call on the company and suggesting that there is a clear path to profitability now for the company. If you take out the Blinkit acquisition, of course, Blinkit acquisition might weigh on profits going ahead, but clearly out of that, besides that, the company is on the right track. Jeffries also, had told investors to go out and buy the stock on the back of the fact that market dynamics for food delivery, guys, remains quite strong. According to another report of Credit Suisse, they're expecting, food e-commerce, Santo, to triple by FY25, and expecting a lot of the food e-commerce companies like Zomato and Swiggy to turn profitable on EBITDA level by FY25. So clearly, I think there is a lot to be positive on the fundamental side, and I think now that the valuations have also become so reasonable after almost 75-80% decline from the top, I think this is one stock that could be on the radar of a lot of HNIs as well as institutional investors.
Well, CJ, at this point, I think people are just investors looking to put money in Zomato are just looking at the price more than anything else. The fundamental factors have all been well documented out there.
Yeah.
Now Zomato seems to be something of what is popularly referred to in market parlance as the falling knife. When it came close to its issue price, people thought that that would be a good support. It fell from there. When it went to 60, people thought, okay, now it's a good bargain. When it crashed to 50, and from there you saw a very strong rebound, which almost a 40% pullback, right? Many analysts turn positive on the stock, but what do you have? Stock has again fallen all the back to 40. Now at this point again people feel, okay, 40 is a good, how low can this stock go? Probably it can't get any worse than this, so let's buy it now. That seems to be the argument. See, Jeffries has also pointed out the same thing, that the Blinkit acquisition is likely to be a drain in the short term. That is one of the big concerns, and plus the company has guided, Zomato has guided for $400 million investment over the next couple of years.
Yes.
That too is likely to weigh on profit. Now if you say, if I exclude this, exclude that, right, I'm in a very good shape. But what's the kind of numbers that's ultimately reflected in the bottom line?
I think the fact is that the Blinkit acquisition, of course, was largely driven by the fact that it was a poison pill, right? They had to do it so as to not lose out on a market share in the quick commerce space. Now the only argument here is that Blinkit's acquisition does not mean that Zomato will not turn profitable ever. All it does is that it delays the timeline by probably another 2 years. If they were to turn maybe profitable by FY24, FY25, now it will turn, it may happen in FY26, FY27. So the only thing here is it's a game of patience now for you. If you were impatient that why is the profitability not coming and therefore you want to sell out the stock and get out, most welcome. But if you are patient enough and you were looking at it as a 10-year journey or 10-15-year journey, then probably another 2 years will not really make a difference, while you can also average down because of the decline that we are seeing in the stock price at this point of time. So it's all about perspective, I think, when it comes to Zomato.
Averaging down, I think investors have been doing that for a very long time in the hope that at some point the hemorrhaging will stop, and there seems to be this seems to be one case where there is no light at the end of the tunnel.
Well, since you always tell me stories about the market, let me tell you, at one point of time Amazon was also down 95%, and we all know where that turned out to be. So you never know. In stock markets you can never say never.
Absolutely, CJ had full marks to you on that one. KEI Industries is the next stock on a watch list. Now decent set of first quarter earnings from the company, and the management was on CNBC TV 18 earlier today, and they said that the main focus now is on increasing retail footprint and also institutional sales and exports. The company is targeting exports of around 750 crores for this year, and it's also hoping for a revenue growth of around 16 to 17%.
Wow, that's it, Santo. I mean, all of this is not really reflecting the price. I mean, if
that's
you look
my
at
line which you're throwing at me,
but
CJ.
like, come on, seriously, look at this. The stock has actually although on a 1 year basis, the gains are pretty, smart, quite handsome gains for the stock. But if you look at it 2020, the stock is only up by 3%. And I mean, looking at the earnings performance seems really great compared to what we are getting, otherwise in the market. I would expect that there would be at least some sort of, up move in the stock overall. But I was really surprised to see that the stock has only risen 3%, which maybe suggests to me that a lot of the gains probably were already factored in. At this point of time, maybe the concerns around margin is something that is, holding the stock performance back. Because even in this quarter, we have seen margins not really be that great, on the profitability front. And I think going by the management committee, they're expecting some of that to come back maybe in the third and fourth quarter, because they're holding decent amount of inventory, and raw material prices will also soften going ahead. But I think market right now would want to see that margin recovery happen to probably provide more re-rating on the stock, or maybe that could be the trigger for upside going ahead. But at this point of time, it doesn't seem like market is fancying the stock too much, given the fact that a lot of the positives were maybe factored in last year itself. One stock, of course, where none of this is really a concern. I mean, the stock is higher by almost 50% this year, Santo, and again today higher by about 2.5% because of the news flow that is emerging out of Europe. Now, global ammonia market, which is a critical market for JNFC as well, that is now under pressure because there is possibility that supply of ammonia might fall. Now, why is that happening? Because earlier today, BASF suggested that they might be cutting down on ammonia production because they just don't have enough natural gas to continue production at the current level. We all know because of the Russia-Ukraine issue, European Union is going to ration out natural gas in the coming winter, and that is of course going to affect a mega industrial complex like BASF. So clearly that is going to result in tighter ammonium production, and that will boost prices, international prices, which is quite good for JNFC as well as its margins. And I think, Santo, this should definitely tell the market that even Q2 and Q3 earnings for JNFC are going to be quite healthy.
Well, no doubt about that. The numbers, there's no dispute on that front. My only worry is the kind of volatility that the stock saw this year, and that is something which makes me a little nervous from, looking at
maybe it's not for you, Santo. The volatility is not
exactly.
For you.
Suddenly the market seems to have, see, the company's numbers were all good for a very long time now, right? No dispute about that. Just that the market wasn't willing to acknowledge that. All of a sudden, between December and April, everyone piles onto the stock. It moves up, almost increases, trebles or almost fourfold within a matter of 4 months. That is a really spectacular rise. And equally swiftly then the stock plunges now. Okay, so it's going through a big seesaw movement at this point in time. While the numbers are good, I can't figure out why there's so much volatility there is. I think I would rather.
I think being a mid cap name, I think that volatility just comes with with it. I think that's the occupational hazard of being a mid cap stock, I guess.
Well, past the stage when I can had the stomach for these kind of
Possibly.
things. Well, Indian Hotels, the last stock on a watch list for this afternoon. CJ, clearly now the economy has reopened. We are now seeing a lot of business travel also happening, plus the conferences, and all these are now moving to levels seen during the pre-pandemic era. So that is one thing in favor of the hotel sector at this point in time. Besides that, for a long time, according to Anand Rathi Institutional Equities, for a long time, the investment, hotels, because they were going through a lean phase, they did not invest enough, and now that will slowly start showing up because of the gap in the gap between supply and demand. So demand is likely to outstrip supply by 4.7% between now and FY22, FY26. So that is the argument of Anand Rathi. You already seen the stock perform well this year. It's close to making a record high. It's around 260. It's been holding firm through the market volatility. This is, I don't think this is a 1 or 2 quarter story really. You might see some fluctuation in the short term, but I think structurally probably the hotel sector is in for a very good time now.
Well, Santo, I think Indian Hotels has already been a 3-quarter story if you include the June quarter now as well. Clearly, there has been a lot of play in or run up in this sector led by Indian Hotels in the first place. And I think I would probably be a little skeptical of what Anand Rathi has to say in terms of demand stretching out till FY26. I mean, yes, people were desperate to get out of their houses because of the lockdown, but I don't think they were that desperate to continue vacationing till FY26. So for me, I think a lot of the pent-up demand that we have seen in the previous March quarter as well as the June quarter might fizzle out going ahead. And of course, the bigger risk, of course, remains what is happening to discretionary consumption because of high inflation. Now, given that consumer wallets are shrinking, I don't know how much discretionary spend like vacation would occupy the consumer wallet share going ahead if we do not see some meaningful decline in overall retail inflation. So for me, I would be a little cautious on the demand story going ahead. Yes, so far Indian Hotels has done well for itself, and yes, of course, because of the lack of investment over the past 3 years in the sector, clearly supply is at a lower level than demand. But it does not mean that demand would continue to stretch out into 2-3 years of excess demand and lower supply. With respect to Indian Hotels, I think the company is less into expanding its capacity, given the fact that they are getting into a more asset-light model compared to, say, somebody like a Lemon Tree Hotel, which is trying to expand its footprint as much as possible. So it will be very interesting to see how Indian Hotels fares, whether it ends up losing market share because it does not want to take more debt into its balance sheet and expand very aggressively. It will be a very interesting story to watch out for.
Well, at this point, I would say that its strong balance sheet and the dominant position in the industry are two of the things going in favor of Indian Hotels.
Absolutely. I think, Santo, we should take a quick check of the market, how we are doing. Just 10-15 minutes ahead of close, and clearly it's quite strong. I mean, we are heading towards a day's high on the Sensex and the Nifty, higher by about 1%. And clearly banking names are the ones that are leading it. Santo Nifty Bank higher by about 1% at this point of time, and the Nifty Mid Cap Index is also doing quite well, higher by about 1.2%. So clearly, Santo, it doesn't seem like we have any nerves ahead of the FOMC meeting.
That looks like it, but tomorrow will be another story.
I just hope these people are not. I mean, I hope if people are taking long positions at this point, they're not quite caught on the ugly side tomorrow morning, just in case the Fed surprises us negatively.
Well, the Fed also may not want to really overplay its hand at this point, when there are already indications that the recession is not far. In
fact, we might already be in a recession. I mean, we have to wait and see what happens with the Thursday GDP data. If we actually see, a contraction in the June quarter GDP data for US, then US technically, or colloquially speaking, would actually be in a recession while the Fed was raising heights. So that will be a very interesting dynamic to watch out for. Santo, before we head on to what I'll be watching out for, actually one of our viewers, Abhishek Ranjan, had a question for you, and this is an interesting one because I also want to know what this is about. So the question is, how does ESOP affect stock prices, right? Recently, the example he has quoted, Intellect Design has been brought out a ESOP plan for their employees. Now, this is a positive news or a negative news? How does that work out?
Well, see, if you have to retain the best employees, then I think ESOP is
I mean, it's been part of corporate culture for decades.
It's been a part of, yes, exactly, CJ. So shareholders don't look at it very favorably, but that also depends on the quantum of ESOPs because at the end of the day, ESOP is a equity dilution, right? There is a cost for existing shareholders, but in highly competitive industry where there's a race for talent all the time, tech is clearly one of that. So how do you retain your best employees? One way is to keep increasing the salaries, but then that will show up in the margins. Already you're seeing that in the IT services industry, because there's a point beyond which it doesn't make sense to keep increasing remuneration. Then ESOP becomes the best way. I think as long as the company is not going overboard. In terms, there's been many cases where there's actual misuse of that, where their ESOPs are very lavishly handed out.
I mean, startups are
that
known
is something
for
which
giving out a lot of equity to their employees.
Shareholders should keep an eye out for. But as far as ESOP go, to retain the best talent, especially at a time when you're facing a severe talent crunch, I think that's the way to go.
Well, I hope Abhishek Santo has cleared out his, your doubt. Of course, the professor himself. Hopefully. That said, quickly let's move on to the last segment of the of the evening, and that is what is on the horizon. And Santo, I think clearly it goes without saying the Fed is the most important event. Later in the evening, we will have the FOMC statement coming out. The expectation, as Santo said, is that there could be a 75 basis point rate hike, but it will be important to see what Chairman Jerome Powell has to say in the press conference that will follow. Could it be a dovish, statement from Powell? Could he play good cop while the FOMC plays the bad cop? We'll have to wait and watch. Apart from that, of course, earnings. You have Dr. Reddy's, Shree Cement, SBI Life detailing their Q1 earnings tomorrow. Along with that, you have Nestle and Jubilant Foodworks also coming out with their June quarter numbers. And of course, the market will later in the evening tomorrow morning will be reacting to the Tata Motors as well as Bajaj Finance Q1 earnings. So clearly, a lot of earnings to react to, as well as some, a corporate macroeconomic event. And also do not forget that tomorrow is the expiry of the July derivative series. So a lot of volatility would be expected.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thanks for watching, and please do share your feedback on the show.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for the rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live tomorrow morning at 9 a.m.